Namaskar, my dear CMA Inter students. I am your Satish sir.
And I am your CMA Rahil Bhaiya.
Friends, today we are going to do revision of your cost accounting subject from the most power-packed, colorful, dazzling notes prepared by your CMA Rahil Bhaiya.
And overviewed by CA Satish Jalan sir.
Friends, you should be now ready with all your belts tied up and
You should put your headphones on, download the notes from description and get started.
yes, get ready as fast as possible to study the costing in the most unique way.
The paper pattern which we have prepared from the past trend analysis is 1 to 15 multiple choice questions, 2A either from cost sheet or job costing, material and employee costing 2B, 3A overheads, 3B either from control accounts or reconciliation, 4A operating costing, 4B contract costing.
5A joint and byproducts chapter or process costing chapter. 5B standard costing chapter. Question number 6 full 14 marks marginal costing chapter. 7A budget and budgetary control chapter. 7B cost accounting standards full theory question. 8A, 8B, 8C are all theory. 8A from first chapter, which is introduction to cost accounting, the basic chapter. 8B material costing theory and 8C cost accounting standards or employee costing theory.
So now let's discuss the format of cost sheet. Direct material consumed, opening stock of raw material plus additions or purchases minus closing stock of raw material minus sale of scrap. Add direct labor cost or factory wages plus direct expenses, we get prime cost, plus works, factory, production or manufacturing overheads, we get gross factory or works cost.
One very important thing to remember is when you are calculating material consumed, you should not include GST if it is given, provided the input credit of GST is available. Another important thing is if there is any kind of cash discount from your suppliers while purchasing the material, that is excluded in the cost of materials. Next, after gross works cost, you are adding opening WIP less closing WIP to get the net works or factory cost. Then you will add three major overheads, which are quality control overheads, research and development overheads, administration overheads of production nature. Now how much will be of production nature will be given to you. Deduct recoveries from scrap or any kind of recovery done from your suppliers or vendors or any customers recovery. Means sometimes customers do pay for your cost. So if that is given, you have to deduct that. Add packing cost, especially the primary packing, not the secondary packing. Secondary packing is a selling cost, so it should not be added here. The result that you get is cost of production.
After getting the cost of production, add opening stock of finished goods less closing stock of finished goods, we get the cost of goods sold, plus administrative overhead marketing related, plus marketing overhead that includes selling overheads and distribution overheads, we get the cost of sales, plus profit, we get the sales.
Interest cost, if given, to be added to cost of sales only when the question is asking you to prepare costing PL account. Normally interests are financial items and are supposed to be excluded from the purview of cost sheet, but if interest cost is specifically given, you may only and only add to cost of sales to find net cost of sales, and usually this is done when you are asked to find the profit as per costing PL.
Now let's begin with material cost. Landed cost computation, domestic purchases, invoice price minus trade discount plus GST plus insurance plus freight, which is also known as CIF, plus delivery charges minus rejection minus rebate plus handling charges. For imported, FOB value plus insurance plus shipping charges, which is also known as CIF, plus import duty plus delivery charges. Self-manufactured, direct material, direct labor, direct expenses, production overhead plus administration overhead, manufacturing related.
Next is EOQ, economic order quantity. That is the quantity which when ordered would minimize total raw material inventory maintenance cost. The formula to calculate EOQ is root over 2AO by C. A means annual consumption, O means ordering cost per order, C means carrying cost per unit per annum. To calculate carrying cost per unit per annum, we do carrying cost percentage per annum multiplied by purchase price per unit. The second is total raw material inventory maintenance cost. This is calculated on annual basis and it has got three components. The first one is total purchase cost, which is equal to annual consumption multiplied by purchase price per unit. When we take annual consumption, make sure that you are assuming opening stock and closing stock are equal or it does not exist. If opening stock or closing stock of raw materials are given, then consumption needs to be changed to quantity purchased, which is equal to consumption plus closing stock minus opening stock. The second item is total ordering cost, which is equal to number of orders multiplied by ordering cost per order. Number of orders is equal to annual consumption divided by quantity per order. The third one is total carrying cost, which is equal to average inventory multiplied by carrying cost per unit per annum. Average inventory is equal to quantity per order by 2 and carrying cost per unit per annum is equal to carrying cost percentage multiplied by purchase price per unit. Remember, the working, if you are doing for EOQ purpose, then the value of quantity per order will be coming from EOQ formula, or if you are doing the workings for the given quantity to be ordered, then you have to take whatever is given to you in hand. Many times the question will ask you to compare economic order quantity with the supplier's offer, which is usually given to you at some different quantity per order. So for that, you make a comparative total raw material inventory cost calculation, one column for EOQ based and another column for supplier's offer based. The supplier's offer are usually applied on the purchase price per unit, thereby affecting purchase cost as well as carrying cost. Supplier's offer will also affect ordering cost by reducing the number of orders, usually. There is another way to calculate a combination of total ordering cost and carrying cost, and it is done by root over 2AOC. This time we are not dividing it by C, we are multiplying AO with C. So this gives your combined total ordering cost and carrying cost. Remember, this is applicable only when your quantity per order is equal to EOQ. If supplier's offer is given, then you cannot calculate your total ordering and carrying cost using this formula. Total ordering and carrying cost is also called as total relevant cost.
Now, EOQ with different price levels. Find total raw material inventory cost at each level by assuming an arbitrary quantity from each range and select the range with minimum cost. Now, EOQ with lead time. Safety stock is equal to average rate of consumption into lead time. Raw material inventory maintenance cost is equal to step 2 plus safety stock into carrying cost per unit per annum.
Stock levels. To calculate stock level, the precondition is that the company has a policy to keep stocks to manage lead times. What is lead time? Lead time is the delivery time. That is the reordering period. That is the time taken between placing the order and receiving the materials. To compute stock levels, we have two situations. One without safety stock, another with safety stock. Safety stock means the stock which is always available with the company and it is the quantity of stock which is there just before the delivery of fresh material is received. The first stock level that we need to compute is reorder level. It is also called as reordering point or ordering point. It is calculated in two situations. Firstly, without safety stock, it is equal to maximum lead time into maximum rate of usage.
And with safety stock, it is average lead time into average rate of usage plus safety stock.
The second stock level is minimum stock level or the safety stock. To compute this in without safety stock situation, we take reorder level minus average lead time multiplied by average rate of usage.
And in case with safety stock, it's only safety stock because safety stock is the minimum level.
The third level is maximum stock level. Maximum stock level is the stock that is there with the company just after the delivery of fresh material has been received. To calculate it in without safety stock situation, we take reorder level minus minimum lead time into minimum rate of usage plus reorder quantity or economic order quantity.
And with safety stock, it is safety stock plus EOQ.
The next one is average stock level. Average stock level is equal to minimum stock level plus maximum stock level divided by 2.
Here with safety stock, it is safety stock plus half EOQ.
Another very different stock levels which is computed very often is called as danger stock level. Danger stock level is equal to emergency lead time multiplied by average rate of usage. I would like to add here that the level of danger stock lies below reorder level but above minimum level.
Store ledger card. FIFO method, the old will be issued first. In LIFO method, the new will be issued first. Weighted average, combined will be issued. Shortage will go to issues. Return, it will be receipts at the time of initial issue. Treatment of shortage, it will charge to factory overheads. Raw material consumed is equal to opening stock plus raw material receipts minus closing stock minus shortages, or issues minus shortages.
Material storage procedure. Here we learn different kinds of storing system for materials inside the stores. For that purpose, we have certain systems and certain documentation. One of the very popular document is bin card. Bin cards are prepared by storekeepers to keep a record of whatever materials comes in and whatever materials goes out, and it is prepared separately for each bin. You should also know difference between bin card and store ledger card. Store ledger card is prepared in the accounts department. The purpose there is to find out the value of inventories, applying FIFO, LIFO, weighted average or simple average methods as applicable in company's policy. But the purpose of bin card is only to keep the control over raw materials which are lying in the stores. The second thing that you should know is the systems of stores organization. The first one there is centralized system that talks about having one main store only, and every department that needs material will have to reach out to the main store. The second one is decentralized system, whereby there is always a main store, but there are several small stores inside the departments or outside the departments which need the materials, and those small stores are called as sub-stores and are controlled by the main store. The next is the impress system, which talks about ease of stock level maintenance and regular ordering of materials. If you create an impressed quantity, that means the purchase department will always maintain such quantity of stock in the stores for the particular item for which impressed has been created. Then there is two bin system. In this, every material is kept in two separate bins. One bin called as safety stock and another for regular use of production.
Now let's move to perpetual inventory system. Here we follow the inventory system continuously, means we record the inventory as soon as we receive it. Now inventory turnover ratio, raw material consumed per annum divided by average stock of raw material. The higher it is, the better it is. Now raw material stock holding period 365 days or 12 months or 52 weeks divided by inventory turnover ratio. The lower it is, the better it is.
The perpetual inventory system, which Rahil Bhaiya talked about, is also called as continuous inventory management system, which is the real-time inventory management system whereby every receipt, every issues are noted on real-time basis as and when the situations occur, such that at any point of time, if the stock is taken, that would actually match with the actual stock lying in the stores. So this helps organization to have an authentic material storage system.
Material analysis procedure. First is ABC analysis. Raw material cost, when 70%, it is classified as A, means the degree of control is high here. Now when the raw material cost is only 20%, we classify the item as B, means here we have to take moderate control. And when we classify it as C, it is only 10%, means we have to keep a low control here. Weight analysis, it is for spare parts, that stands for V is equal to vital, E is for essential, D is for desirable.
Then there is JIT system, that is just in time system. The term has come from Japanese inventory management system, pioneered by Toyota. It talks about a system where the company will not keep any stock of raw material or WIP or finished goods and thereby manage its entire production and purchase system such that it can meet the requirement of the customers as soon as possible. And that's how the word just in time means the customer's requirement would be met just in time by speeding up, by increasing the efficiency, by better planning. FSND, it is another method to analyze the materials which are fast moving, which is usually consumed within 1 month. Then S is for slow moving, which is consumed within 1 year. Then N is non moving, which are not being used since 1 year and are ready for disposal. And D is for dead stock. So dead stock are also usually ready for disposal.
Labor costing, wage bill computation. Now there are 4 parts under wage bill computation: gross wages, cash earned by workers, labor cost to the company, and allocation to jobs. First, gross wages is equal to basic plus bonus plus allowances plus overtime premium. Cash earned by workers is equal to gross wages minus employees' contribution to PF and ESI minus professional tax. Labor cost to the company is equal to gross wages plus employers' contribution to PF and ESI plus fringe benefits.
While calculating labor cost to the company, remember that any kind of advance given to employees does not form part of labor cost. Whatever labor cost we are computing needs to be apportioned to the respective jobs for which workers have worked. While apportioning, you have to also remember that if any specific item of expense has been incurred for any specific job, then that has to be allocated to that job only. For example, if overtime is done for only job X, then it has to be allocated to job X and the rest of the items will be apportioned to various jobs in the ratio of time. The second item that you have to study in this chapter is basic wages computation. Basic wages computation are done under 2 popular systems. One is time basis, another is piece basis. On a time basis, you can expect good quality of work, but the cost can be higher because the workers are paid for the time worked. Basic wages here is equal to hours worked into wage rate per hour. And under piece basis, you can expect more quantity but lesser of quality. And the wages here is equal to quantity produced multiplied by piece rate per unit. Piece rate per unit is nothing but standard wages for 1 unit. And to calculate it, you can take standard wages for a specific period, for example, for a day or maybe for an hour, and divide it by estimated output, which we can expect over the period of time. Remember, if you're taking in numerator standard wages for 1 hour, then you have to divide it by units to be produced in 1 hour. There is another system called as guaranteed time system, which is usually for new workers who are unable to produce more output as expected. So the company here guarantees higher of wages under time basis and piece basis.
Now let's move to bonus scheme computation, which is on time basis. So here are 3 methods of bonus computation. First one is Halsey scheme. As the name suggests, Hals means half goes to the management and half remains with the worker. So the formula here is half into time saved into rate per hour. Second one, Halsey-Weir scheme. Here 1/3 remains with the worker. That means the formula is 1/3 into time saved into rate per hour. And the last, Rowan scheme. Here it is allowed on the basis of time allowed. That is time taken upon time allowed into time saved into rate per hour.
Total wages, if computed under any of these schemes, implies that you have to also take basic wages under time basis, then bonus as per formula applicable, and third one is the allowances also if it is given. Sometimes questions may say Halsey 60% bonus scheme, then you have to take 60% in your formula instead of half. Same way the question may also specify Halsey-Weir 40% scheme, that means you have to take 40% instead of 1/3. 2 very important note. Number 1, Halsey bonus is equal to Rowan bonus when time taken by time allowed is equal to half. Secondly, as per management, which is quality conscious, the appropriate scheme would be the Rowan scheme because if workers try to save more time, the bonus will reduce. As per workers' preference, who always want to earn more for more time saved, the preference would be Halsey's scheme. At the end, you may be required to calculate effective wage rate per hour, and that is equal to total wages, which is the cost to the company, divided by effective hours worked. Effective hours worked means total available time minus idle time, if any.
Part B. Overtime premium and its treatment. You have to remember when there will be overtime. So, when the actual working hours are more than the normal working hours, then there will be overtime. As per the Factories Act, overtime will occur when you work for more than 9 hours per day or more than 48 hours per week, the higher of the two. So what is overtime premium? It is 100% off basic plus DA plus tiffin allowance. That means the total wages will become 2 times of the normal wage rate.
Treatment of overtime premium depends on the reasons for which overtime has been done. The first reason can be due to continuous shortage of workforce, and that's why the organization is doing overtime regularly as a part of its policy. In that case, overtime premium is added with the normal wages to find out the total wages and divided by hours work to find out the inflated wage rate, and this inflated wage rate is used to calculate wage cost for any job. The second reason can be due to customers' special request to expedite the job. In that case, overtime premium is calculated separately and charged to that specific job as a separate breakup item of wage cost. The third reason can be due to fault of specific department. In that case, charged to that department's overhead. The fourth case can be any irregular requirement which doesn't happen in the factory regularly, but it is not so abnormal. In that case, charged to factory overhead of the job. In the last case, if overtime is done because of any abnormal reasons, then we charge it to costing PL.
Now moving on to part C, efficiency ratio. It is equal to standard time for actual output divided by actual time, or actual output divided by standard output in actual hours, or actual cost upon standard cost.
To remember the formula of efficiency ratio, if you use the basic logic which says that if worker is efficient, its efficiency ratio has to be more than 1 or more than 100%. So on time basis, if you see that a worker's standard time is 10 and actual time is 8, you can understand that the worker is efficient, so the formula would be standard by actual time. And in case of output, if actual output is 100 and standard output is 80, you can understand the worker is efficient because it has produced more, so the formula will be actual output divided by standard output. And the same goes with the cost. If cost is in standard 100 and in actual it was 80, so you can understand worker is saved, so it is efficient. And if it is efficient, the formula has to be greater than 1, so it will be standard cost by actual cost.
Now let us learn what is the formula for standard time for a job. It is basic time allowed divided by 1 minus allowance percentage.
What is this basic time allowed? Basic time allowed is nothing but actual productive time multiplied by efficiency ratio. And this formula can also be understood from the previous efficiency ratio formula on time basis. If you compare this, there it was efficiency ratio is equal to standard time divided by actual time. That actual time is nothing but actual productive time, and from this if you calculate your standard time, that will be efficiency ratio to actual time. Remember, from efficiency ratio formula, whatever standard time for actual output you are getting, that is only called as basic time allowed. And when we are calculating standard time for a job, we are further inflating this standard time which you got from efficiency ratio by the allowance percentage.
Now moving on to the measurement of labor turnover rate. So there are 4 formulas for measurement of labor turnover rate. The first one being replacement method. As the name suggests, it is number of workers replaced divided by average number of workers. So what is average number of workers? Opening workers plus closing workers divided by 2. Separation method. Similarly, number of workers separated divided by average number of workers.
The third method is addition method or accession method. Accession method is equal to number of new workers joining the company because of any kind of expansion plus number of workers replaced divided by average number of workers. And the fourth one is flux method. Here you are taking in numerator half of workers replaced plus new plus separations divided by average. Remember, you have to take half of numerator. In this working, one very important cross check is there, which helps us sometimes to find out any kind of missing figure, which is equal to opening number of workers plus new additions plus replaced minus separations is equal to closing number of workers. So if you do this cross check before solving, it helps us sometimes to determine any kind of missing numbers.
So now let's learn how to compute the profit foregone due to labor turnover. So basically there are 4 steps to compute the profit foregone. The first step is to calculate the total productive hours. Out of the total hours worked, there are 2 type of hours. First one is the productive hour and second is the training hour. The training hour is further subdivided into 2 categories, the productive training hour and unproductive training hour. So the productive hours is equal to productive hour plus productive training hour. Second step, contribution earned, which is equal to sales minus variable cost or sales into PV ratio.
The third step is contribution per productive hour, which is equal to step 2 by step 1. Fourth step is to find out the total hours lost due to labor turnover, which is equal to whatever hours given in the question, the hours lost due to vacancy plus unproductive training hours. Profit foregone is calculated as opportunity cost plus actual cost due to labor turnover. And opportunity cost is equal to contribution lost due to labor turnover, and that contribution lost is equal to your step number 3 multiplied by step number 4, and the actual cost would always be given in the question.
Now let us learn how to compute the bonus based on efficiency. We have already learned how to compute bonus based on time. Now we will learn how to compute bonus based on efficiency. The first, Emerson's efficiency plan. If your efficiency level is below 66 whole 2 upon 3%, you will get no bonus. If your efficiency lies between 66 whole 2 upon 3 to 100%, you will get 20% as bonus. And if your efficiency lies above 100%, you will get 20% plus 1% for every 1% increase in your efficiency. Second, the Taylor's differential piece rate. If your efficiency is less than or equal to 100%, you will get 80% of normal piece rate. But if your efficiency is more than 100%, you will get 120% of normal piece rate as bonus.
So if you see, Taylor was very shrewd. So even if our workers are achieving 100% efficiency, he was not even willing to give even normal piece rate. He said, I will give you only 80% if you are only achieving up to 100%. So that's why Merrick's multiple piece rate system was discovered, which said, let's be some considerate to our workers. So we have up to 83% efficiency giving the normal piece rate, and if the workers are achieving up to 100% from 83%, then 10% extra on the piece rate, and if the workers are going more than 100%, then 20% extra on the piece rate as bonus. Fourth is Gantt task bonus plan. Here it is said that efficiency, if it is less than 100%, that means if the workers are inefficient, then they should get only time wages, and if workers are exactly equal to 100% efficient, then they should get 20% bonus over time wages, and if the efficiency of the worker is more than 100%, then they should get 20% bonus on piece wages.
Now, Bath system, that is root under times taken into time allowed into rate per hour. You need to keep in mind that rate per hour is out of the square root. Now, Bedok system equals to time saved is equal to standard time minus actual time. And now we get the bonus points. That means every hour saved is equal to dash bonus points. That will be specified in the question. If not specified, you assume 1 bonus point is equal to 1 hour saved. Now the bonus is equal to 75% of bonus points into wage rate per point.
Why this 75%? It's just like Halsey's system, where half was being given to the workers. Bedok's was very generous. He said 75% be given away to the workers. The next is the group bonus scheme. This is only given when workers are working in a group. So at first we find out the total wages of workers in the group and subtract that with the time wages in the group. The difference is called as group bonus. In many questions, group bonus may be required to be calculated as a percent of the basic wages of the group. So you have to read the question wisely to determine how exactly the group bonus is coming. If say group bonus has come as a difference between total wages of the group minus time wages of each member of the group, then the surplus amount needs to be distributed on some basis to every group member, and that is usually done by way of ratio of hours worked by members in the group for a specific job.
Overheads. The first one, semi-variable overheads. Now, how to recognize whether an overhead is fixed, variable or semi-variable? For semi-variable overheads, neither the total is same nor the per unit is same.
So we need to take breakup of semi-variable overheads into fixed and variable. And in order to do this, the three conditions that must be satisfied are: number one, the fixed part should always remain same or constant. Number two, variable cost per unit should also remain constant. And number three, minimum 2 activity level or capacity level details should be given.
Now, for computation of semi-variable overheads, there are two methods. The first one is high-low point method. Under this method, we will first compute the variable cost per unit and then we will compute the fixed cost. Variable cost per unit is equal to change in total cost divided by change in units. Now, after computing the variable cost per unit, we will compute the fixed cost. Fixed cost is equal to total cost minus total variable cost. Second, simultaneous equation method. Total cost is equal to variable cost per unit into units plus the fixed cost.
Using this equation, you will be finding two simultaneous equations and solving them, and you will get the value of variable cost per unit and fixed cost. If fixed cost is reducing by certain amount in next period, then you need to add that amount back to the total cost of the next period before using any of the above methods, and then use your either formula or the equation. Sometimes capacity level or activity level may be given in the form of percentage instead of units. In that case, step 1, assume 100% is equal to 100 units, and step 2, solve according to applicable methods of high-low or simultaneous equation.
Now moving on to primary and secondary distribution. Primary distribution. Under primary distribution, either we allocate or we apportion. What is cost allocation? We allocate the cost specific to that department only, whereas in apportionment, we distribute the common cost to different departments in an equitable manner.
For allocation, you don't need any kind of ratio. You have to read the information and put the specific item of cost under the specific department. But for cost apportionment, you need ratio, and that ratio may not be directly given to us in the question. You have to read the item of cost and identify the justified ratio. For example, for rent we use floor space, for lighting we use
Number of points,
for depreciation we use
number of machines,
or we can also use the value of assets. For indirect wages we use
basis of direct wages.
direct wages, or we can use direct labor hours. So this way you find out the right basis for various items of cost and use that for apportionment. The result obtained is total cost of various production department and service department. Remember, when you're doing primary distribution, it is done for both production and service department. And while doing this distribution, one special item that needs worth mentioning is that direct material and direct wages of production departments are not considered as part of primary distribution, but direct material or direct wages of service departments are part of overheads, so these are part of your primary distribution.
Secondary distribution. So what is secondary distribution? Under secondary distribution, we reapportion the cost of service departments to the production departments. Under this, there are two methods. First one is reciprocal, which means that the service departments provide services to service department and to the production department. But in case of non-reciprocal method, the service department provides services only to the production departments. the non-reciprocal method. There is no exchange of services to the service departments. Direct method. In this, we allocate the services of the service department to the production department in the ratio specified in the question. Second method, step ladder method. Under this, there are 4 steps. Step 1. Total hours of services given to the outsiders is computed. You need to keep in mind the measurement of service should be same. Step 2. You need to rank the services provided by the services department based on these higher services. Step 3. Distribute the first ranked service to the production department and then to the secondary departments. Step 4. Distribute second ranked service to first production department and then to service department except rank 1 and continue this process.
If say basis of measurement is not same in case of step ladder method, in that case the first step will be a little different, and that would be to first determine the percentage of service given by one service department to another service department, and using that percentage you would be ranking and proceeding with step 3 and 4. The next is reciprocal basis. Under this there are 2 methods. One is repeated distribution, another is simultaneous equation. There's another method called as trial and error method, which is not so regular in exam, so we have skipped here. Repeated distribution method says that the service department cost will be distributed to all other departments, that is to production department as well as to other remaining service departments. And next step would be to reapportion the total cost of other service department, and that will be apportioned to production department and the previous service department. Now this service department has again got the cost, so this cost will be reapportioned again to all production departments and the other service department, and every time you proceed you will see that the amount in the service department is getting smaller and smaller. This process will continue until the amount left is so negligible that you can round it off and just give it away to any department. The second step, the second method is the simultaneous equation method. Simultaneous equation method is applicable only when there are 2 service departments. Here you need to first make 2 equations. The pattern to make the equation is you have to assume the total cost of service departments as X and Y, and this total cost is equal to overhead as per primary distribution of that service department plus percentage of service received from other service department. So percentage of service will be given to you in the question and has to be read wisely, because sometimes it may be misguiding you, so you have to read properly. So the equations usually run like this: X is equal to amount of primary distribution plus say 10% of Y, something like this, and another equation would be Y equal to amount of primary distribution plus some percent of X. There's a special way to solve this equation, which is only by substitution. So you put the value of X in another equation and get the value of Y, and then use this value of Y to get the value of X.
Capacity determination. Now what is capacity? The ability to produce is the capacity. Now we have got 5 types of capacity ratings: maximum, theoretical, installed or rated capacity. What's the formula? Units per hour multiplied by hours per day multiplied by number of days per year.
Next is practical or achievable capacity. When we compute this, we compute by taking 3-step calculation. Number 1, working days calculation, which is also called as practical days. Practical days are equal to total days minus holidays minus weekly offs. Then there is practical hours, which is equal to practical days multiplied by hours per day. Then we subtract here normal idle time or maintenance time. Then there is practical units, which is equal to practical hours multiplied by units per hour.
Then normal, average or expected capacity, which is the past or average of past actual capacity.
Then there is budgeted or estimated capacity, which is used for determining overhead rate for planning. It can be any of maximum, practical or normal capacity.
Now then there is idle capacity. That means when the budgeted capacity is more than the actual capacity. It arises in 2 situations. First is normal and second is abnormal. If it's normal idle capacity, then the formula is maximum capacity minus budgeted capacity. In case of abnormal idle capacity, it is budgeted capacity minus actual capacity.
Then we have cost of idle capacity, which is equal to idle capacity multiplied by overhead absorption rate. If idle capacity is in hours, then calculate overhead absorption rate using hours. How will you calculate overhead absorption rate? That is equal to your total fixed overheads divided by budgeted capacity.
Treatment of idle capacity. If the idle capacity is normal, it is charged to factory overheads. But if it's abnormal, it is charged to costing PL.
Apportionment of overheads using capacity. So if you are apportioning fixed overhead, then you should use budgeted capacity as basis, and if you are using variable overheads, you should use actual capacity as basis.
Moving on, then there is absorption costing. Now we will learn how to compute the overhead absorption rate. The formula is budgeted overhead divided by budgeted basis.
Budgeted overhead is equal to total fixed overheads. This concept assumes all your overheads are fixed in nature.
The budgeted basis are production overhead. It can be quantity produced, labor hour, machine hour, direct labor, direct material or prime cost.
For admin and selling overheads, the basis are admin overhead, quantity produced or factory cost or conversion cost. How do you calculate conversion cost? It is direct wages plus factory overhead. For selling overhead, it is either quantity sold or cost of goods sold or sales. How do you identify which capacity is ideal for the solutions? So either you have to read the question properly, something will be mentioned. If not, then we see what is available and we use this available information in the order of the priority of the basis which we have noted in the notes. Like for production overhead, you will be first preferring quantity produced if no other details are given. If say hours details are given, then we always go by hours information first.
Now, after computing the overhead absorption rate, we compute the overhead absorbed. How do we compute it? It is computed by the formula overhead absorption rate multiplied by actual basis for the job or the period.
We then calculate estimated cost, or we prepare a job cost sheet, which is just the normal cost sheet in the order of direct material, direct labor, direct expense, and then you take production overhead absorbed, and then the result will be called as factory cost, and then you add admin overhead absorbed. The result is called as cost of production. Then you add selling overhead absorbed. Result is called as cost of sales. If profit margin is given, add it and find out the selling price. Remember, in this estimated cost sheet, we don't take opening stock or closing stock in general.
After computing the overhead absorbed, we compare it with the actual. If the overhead absorbed is less than the actual overhead, that means there is a situation of loss, that is under absorption. But if the overheads absorbed are more than the actual overhead, this is a situation of gain, that is over absorption.
Once you have determined how much is under absorbed or over absorbed, you need to do treatment of such under over in your books of account. And for treatment, we have three different methods. So first treatment is maar diya jaye. That means
the amount is immaterial and it is transferred to costing PL.
Then second method of treatment is chhod diya jaye.
Here the amount is significant, so we carry it forward.
And the third scenario is chun chun ke mara jaye.
This is the most preferred method, and here we apportion the entire production using supplementary overhead rate.
Supplementary overhead rate is equal to the amount of under absorption or over absorption divided by equivalent quantity produced. Equivalent quantity produced is equal to quantity sold plus closing finished goods plus closing WIP multiplied by degree of completion. This way, the amount of under or over absorption gets transferred to three heads, which are quantity sold, closing finished goods, closing WIP. So the part which is transferred to quantity sold is adjusted to cost of sales. The part which is transferred to closing finished goods gets added to finished goods control or added to closing finished goods inventory, and the part that is closing WIP related gets adjusted to WIP control. The amount, if it is under absorption, will be added. The amount is, if it is a over absorption, then it will be subtracted. One more very important thing to note: before doing this treatment, you have to also see whether any under absorption is because of faulty planning. Then you have to subtract that under absorption and transfer to costing PL only, and for remaining you will do these three, either of the three treatments. Another important thing to note here is when you are calculating your under absorption or over absorption by comparing overhead absorbed with actual. This actual should not comprise of any kind of abnormal items. So in case if it is having any abnormal expenses like strike wages or power failure related expenses, then those abnormal expenses included in actual should be first charged to costing PL and then compared with overhead absorbed to find out the under absorption. So to sum up, first you will take overhead absorbed, then you will take actual overhead excluding abnormal expenses to get under absorption. Then you will subtract any under absorption due to faulty planning, which will go again to costing PL. The net amount of under absorption would be distributed using any of these three steps. If in question nothing is mentioned, always write about all the three steps.
Moving on, types of overhead absorption rates. There are three types of overhead absorption rates. The first one is departmental or multiple overhead rate, second blanket or single overhead rate, and third one is comprehensive overhead rate. If we talk about the departmental or multiple overhead rate, it is computed for each department. The formula here is departmental overhead divided by departmental basis. Second, the blanket or single overhead rate. It is computed for the entire factory. Here the formula is total overhead of all departments divided by total of all bases. The third one is comprehensive overhead rate. The formula here is direct wages plus overhead divided by basis.
The next is machine hour rate. So in machine hour rate, we generally learn how to find the rate per hour to run a machine. You can have one single machine, which is a big machine, or the entire department of machines for which you are finding the rate per hour. The first concept in this is single tier machine hour rate or the normal machine hour rate. That means it is being calculated either for one machine or for one department for one specific use case.
Types of time calculation. There are three kinds of time under this: setup time, product maintenance time, and operating time. Setup time and maintenance time are only considered productive if the question specifies, but the operating time is always considered productive.
Steps to calculate two-tier machine hour rate. There are 5 steps. First is to find the common expenses. Normally these include your rent, depreciation, etc., which are common to any kind of time for which machines are used. Second is to find out total common hours. That will be adding up the two types of time for which we are calculating two-tier machine hour rates. Third is to find out common expenses per productive hour, which will be step 1 divided by step 2. Fourth is to find out separate expense per productive hour, which is applicable for any specific situation. It may not be same for both the situations. And the last step is to find out two-tier machine hour rate by adding common expense and separate expense in the two respective situations.
Now moving on to the next chapter, that is reconciliation. Reconciliation is done only in case of non-integrated system. Here we prepare the reconciliation statement or the memorandum reconciliation account, which is a ledger account. Now what are the steps? First we need to prepare the cost sheet, then we need to prepare the financial profit and loss account, and then we reconcile the two.
While preparing cost sheet or financial PL, you have to remember some important stuffs. First is about raw material inventory amount. Raw material inventory, if it is given, then the amount of inventory would be same in C and FA if nothing else is mentioned. For closing WIP inventory also, we assume same in both CA and FA, but closing finished goods will always be different because in CA we include admin overhead as a part of cost, but in FA we never include that. Normally in questions you will get value as per FA, so don't copy that in cost sheet. In cost sheet, calculate cost of production, use FIFO method to find out the closing stock of finished goods. If you further see the major items of differences in CA and FA, the items would be number 1, inventory valuation, number 2, overhead absorption, number 3, financial income or expenses which are not shown in CA, and opportunity cost which are not shown in FA. Normally in calculations, opportunity costs are not given. You majorly work on the first 3 items. While preparing a cost sheet, remember the overheads that you are also showing will not be copied from FA. That has to be overhead absorption rate. If overhead absorption rates are not given, but output details are given in your question, then you can find your overhead absorption rate by taking actual overheads by budgeted output. Why we are taking actual overheads by budgeted output? Because we have to take an assumption here, which is actual overhead is equal to budgeted overhead. Also, when you are finding this overhead absorption rate, if in question overhead breakup is given as fixed and variable, then this overhead absorption concept is applicable only on fixed part of overheads. For variable overhead, we assume whatever is in actual, the same will be in absorption.
Now, let's talk about the rules for reconciliation. First, starting point. Begin with profit given on left hand side and reconcile it to the required profit that is given on the right hand side.
For example, if you started with profit as per cost accounting, take that on your left hand side and keep the other one, the profit as per financial accounting, on right hand side. You should do this by writing in your notes as working note, not by use of hands in your exam.
The second point, you need to identify the differences. Check items that differ in both cost accounts and financial accounts. Debit item reduce the profit while credit items increase the profit.
For instance, if you find overhead absorption and overhead actual amount are different, that means in cost accounting, factory overhead is shown as 1 lakh, that is overhead absorbed amount. So factory overhead is what? It is a PL debit item, so it will reduce profit in cost accounting by 1 lakh. So in cost accounting, you will show it by way of downward arrow of 1 lakh. And in financial accounting, say this amount is 80,000, which is the actual amount. So in financial accounting, this will reduce profit by 80,000.
The third step, show effects. You need to indicate the items that either increase or decrease the profits using the arrows. The items that increase the profit should be indicated with an upward arrows, while the items that decrease the profit should be indicated with downward arrow.
So this I already have shown by moving my hands here as regards factory overhead item. Now what to do next?
Fourth step, now you need to reconcile. Adjust the left hand side to match with the right hand side by adding or subtracting the differing items.
So as you can see, the level of adjustment I have not kept same in both the hands. So in case of cost accounting, I had reduced profits by charging overheads by rupees 1 lakh. But here in financial accounting, it was charged only 80,000 because that was only the actual overhead. So we have to always match the left hand side with the right hand side. All right. So that means what you have to do is you have to do all the adjustment on the profits with which you have started, that is cost accounting. So since we started with profit as per cost accounting, we kept that on left hand side. So I have to match left hand side with right hand side. Left hand side got reduced more than the right hand side. So I will add back this difference of 20,000 rupees to reconcile. Similarly, let's talk about one more item to give students another idea. Let's take one item of closing finished goods valuation. So what do you think, Rahil? Where the valuation will be more?
The closing goods will be more in cost accounts. Why? Because we take administrative overhead in the costing PL, not in the financial PL.
Very good. So let's say we have started the reconciliation statement from cost accounting. So that will be on our left hand side and financial accounting will be on right hand side. So closing finished goods, say value is in cost accounting 5 lakhs and in financial accounting it is 4 lakhs. The difference has to be higher usually in cost accounting. So now closing finished goods is a PL
credit item.
So it will increase profit.
Yes.
So I will raise my hand up in left hand side by 5 lakhs, but in financial accounting it
Only
was
by
only
4
lakhs. So now all adjustment has to be done to
in the costing PL.
Left hand side to match it with right hand side. The profit with which we started, we are all adding and subtracting here only. So we will match this with this. So that means it is higher profit. So I will match this with this by reducing the difference, that is less 1 lakh rupees closing stock over valuation in cost accounting. So when we are doing reconciliation, we can do this working in a form of statement or in the form of ledger account, which is called as memorandum reconciliation account. So if you are doing in the form of statement, you will write profit as per CA, then add less and profit as per FA. And if you're doing in the form of account, then you will write the one with which you are starting on the left hand credit side, right hand credit side. Buy profit as per CA, add items on all buy side, less items on debit side, and the result will be to profit as per FA. Now another one more important thing is, if say loss as per CA is given, then what will happen? Do you remember?
Suppose if there is loss in the costing accounts, we'll keep all the rules same and we will use the figure as negative in the reconciliation statement And if we are preparing the memorandum reconciliation account, then we will keep the item, the loss figure, in the debit side instead of keeping it in the credit side.
Very good. So these are only the special situations to prepare your reconciliation statement, and I hope after this you should practice at least one question before you go for your exam.
Control accounts. Under control accounts, we maintain either non-integrated system or integrated system. Under non-integrated system, costing accounts and financial accounts are maintained separately, whereas in case of integrated system, both are combined in a single set of books. In case of non-integrated system, reconciliation statement is also required. The list of accounts which are maintained under the non-integrated system are: there are 3 inventory accounts: raw material control account, WIP control account, and finished goods control accounts.
Then there are 4 expenses accounts. One is wages control account, second is factory overhead control, third is administrative overhead control, and fourth is selling and distribution overhead control account.
There are 2 closing accounts: cost of sales account and costing PL account.
Then there are 2 special accounts which are used only if need arises. The first one being most popular, which is capital WIP account or asset construction account. And the second one is overhead reserve, suspense or adjustment account, to be used only for over absorption and under absorption carry forward.
Then there is one God account, that is general ledger adjustment account or GLC account.
This is only required under non-integrated. Under integrated system, instead of this account, we can open any account which is usually opened under financial accounting system.
Moving on to the non-integrated system journal entries. Material purchased.
It is RMC to GLC.
Second, material returned to supplier.
GLC to RMC.
Material issued to production.
Production is receiving, so WIP to RMC.
Fourth, material returned from production.
Opposite entry, RMC to WIP.
Material transferred from job A to job B.
Since this is not affecting 2 control accounts, it will be not treated as any entry here. We can just write a note.
Material lost in accident.
Since accidents are abnormal, we will say costing PL to RMC.
Material shortage.
Shortages are normal, so it will be factory overhead to RMC.
Material issued for building construction.
Going for building construction, so asset construction or capital WIP debit to RMC.
Special material purchased for a particular job.
Special material means special expenses, so these are like direct expenses directly charged to WIP control, so WIP control to GLC.
Transportation of incoming material.
It's like material purchase, so RMC to GLC.
Admin overhead allocated to production.
If you are allocating your overheads to production, means production is receiving, that is WIP debit to admin overhead.
Or admin overhead allocated to production.
It's the same thing. Allocated to sales will be cost of sales to admin overhead. So this way you can think of any number of journal entries. Say let's put forth for wages. If there are direct wages and indirect wages both given, then first entry that we pass is by adding direct wages and indirect wages. That will be wages control to
RMC. Admin overhead allocated to production.
This time the allocation to production will not go to WIP, it will go to finished goods control. So entry would be finished goods control to admin overhead.
What if admin overhead is allocated to both production as well as sales?
In this case, allocation to production implies WIP to admin overhead, and allocation to sales means cost of sales to admin overhead. I will give one more instance of journal entry for revision. That is, if direct wages and indirect wages both are given, then how to pass journal entries for that? So at first we add both direct wages and indirect wages and pass entry for wages payment, that is wages incurred, the entry would be
wages control account debit to GLC account.
very good. And now we have to also allocate the wages to direct and indirect. The direct part would be allocated to WIP account. So the entry would be
Wages control account debit
WIP debit to wages
to
control.
wages control.
And the indirect part would be allocated to factory overheads. So the entry would be
Factory overhead account debit to wages control account.
wages control. So when you are passing all these journal entries, you may write narration or may not write narration. Pass journal entries only when question is asked about it, or else straight away pass the journal entries in the ledger accounts. Next comes sequence of balancing the accounts.
Under this, there are four main accounts. First is WIP control account, second finished goods control account, third is cost of sales account, and fourth is costing PL account.
In case of WIP control, we have to bring some balances here, and this starts with raw material control, wages control, and production overhead control. So in raw material control, what entries normally you have is opening balance on the debit side, purchases on the debit side, that is to GLC, and closing balance on the credit side, and the remainder should be issued to production, that will be by WIP, which will be coming as a debit to production control account. These are standard items. Apart from this, you can have other material related postings such as shortages or abnormal losses or issued to building construction that you can post as applicable. After this, let's go to wages account. In wages account, you have in debit side to GLC for total payment, and allocation is done to WIP and factory overheads for direct and indirect wages. So direct wages would be going to WIP control, so that will come as a debit in WIP control. So you have two debits in WIP control. One is raw material control, another is wages control. Similarly, in third case, that is factory overhead control, we have total amount incurred as to general ledger control, and whatever is going to production is called as absorbed amount, and that absorbed amount will be charged to this account by creating by WIP account. So in your WIP account, you'll have now third item on the debit side, that will be to factory overhead control. The balancing figure of raw material control is usually balance CD or closing inventory. There is usually no balance in wages control, and in case of factory overhead, the balancing figure is usually under absorption or over absorption, for which there is a customary treatment. In case opening balances of overhead control are given to you in the question, then you will carry it forward. In case opening balances of overheads are not given in the question, that means in previous period we were not carrying it forward, so we have transferred in costing PL, so this period also will transfer to costing PL. Or if question is specified about its treatment, then follow that treatment. So this way you will close the overhead control account. And now we have come to WIP control. There we will have two opening balance of WIP, and then the three debit items, which are to raw material control, to wages control, to production overhead control. And after this we will have by closing balance of WIP. The net figure here will be called as cost of goods produced, which will be transferred to the next account, which is finished goods control account. Coming to finished goods control account, the opening balance of finished goods will be coming on the debit side. The transfer from WIP control will be coming on debit side as cost of finished goods produced. Whatever admin overhead has been absorbed, that will come on the debit side of finished goods control to admin overhead control. Then closing finished goods balance will come on the credit side, and the resultant would be cost of goods sold, which will transfer to cost of sales account. Next comes cost of sales account. On that we don't have any opening balance or closing balance, but we'll have first item as to finished goods control for cost of goods sold. Then we'll absorb selling overheads to this account. So on debit side we'll have to selling and distribution overheads. The entry would be cost of sales to selling and distribution overheads. And the net balance here will be transferred to costing PL by costing PL, called as net cost of sales. Sometimes in question cost of sales return is given, so you can just do the opposite entry of net cost of sales, that is in cost of sales you can write to costing PL if cost of sales return is given. If cost of sales is given, then you write on the credit side of cost of sales as by costing PL. This will be now taken to costing PL. Costing PL debit side, first item would be to cost of sales. Then you will have sales. Sales will be written on the credit side by general ledger control, sales figure. The net amount is called as GP, gross profit. You can carry it down in the same account to GPBD, to GP and by GPBD, right? By GPBD. After that, you will write to under absorption of overheads if we have transferred under absorption to costing PL. By over absorption of overheads if we have transferred over absorption or difference in overheads to costing PL. If we have not transferred overhead absorption to costing PL, if we have not transferred overhead over absorption or under absorption to costing PL, then nothing will come here. Your GP will become NP. Whatever is NP, we take it back to general ledger control.
Journal entries in the integrated system. First, material purchased on credit.
It will be RMC to creditors.
Second, payment to supplier.
Creditors to bank. Remember, for this there is no entry in non-integrated system because under non-integrated system both these accounts gets cancelled out through GLC.
Third, direct material issued.
This entry is same like non-integrated system because here no GLC is involved. So this will be WIP to RMC.
Fourth, direct wages 50,000, indirect wages 30,000.
In this case, first you add up both, that is 80,000, pass the entry for payment which will be wages control to bank 80,000, and then allocate wages to direct and indirect. Direct means allocate to WIP, indirect means allocate to production overhead. So WIP debit, production overhead debit to wages control.
Depreciation charged to plant and machinery.
In general, the financial accounting treatment is depreciation to plant and machinery, and then we transfer depreciation to PL. But here we will transfer depreciation to production overhead. So the combined entry will come to production overhead to plant and machinery. In case of non-integrated system, this will be production overhead to GLC.
Material issued for repairs and maintenance.
Issue for repairs means it will be going to factory overheads. So entry would be factory overheads to RMC.
Bad debt.
Bad debts. In financial accounting, we pass entry as bad debt to debtors and then PL to bad debt. Under non-integrated, there is no entry for this because these all are adjusted through GLC. It does not affect any internal control account, but under integrated accounting, there will be entry for this.
Donation paid.
There will be entry for this just like financial accounting. That will be donation to bank and PL to donation. Under non-integrated, no entry for this because it does not affect any control accounts.
Prepaid rent.
Again, for prepaid rent, under non-integrated, there is no entry. In case there is any prepaid rent, then we can have it as factory overhead opening balance. In case of financial accounting, we pass entry of prepaid rent as prepaid rent to rent. But what will be the entry in non-integrated system for this? So here also in integrated system, this is shown as opening balance of factory overhead account. Alright, so in integrated system, remember that you have to follow 2-3 special items. One is if there is any under absorption or over absorption, then it is not allowed to be carried forward. You have to compulsorily transfer to PL. Second point, you don't make two separate PL in integrated, you make just one PL account and you follow the same balancing system that we discussed to find out your GP, and post the GP you can post all non-costing items, that is your donation or dividend, to find out your net profit. And all under absorption, over absorption will always come into PL itself. Under non-integrated questions, we can make full balance sheet also if in question full opening trial balance are also given. Under non-integrated questions, we don't make full balance sheet because everything is adjusted through general ledger control. So at the end, we usually prepare closing trial balance, which is in this format, particulars debit credit. You have most of the control accounts having debit balances except GLC account. GLC account will have credit balance. Sometimes GLC opening balance is not given to you in the question. Then how will you determine that? You will add up the balances of all other accounts opening balance. If all those are net debit, then the total amount will be coming in the GLC account as net credit balance. So this concludes your control accounts.
Batch costing. In which organizations does batch costing is used?
First, it is most popular in case of pharma, medicines, biscuits and other daily eatable products.
Now, what is the cost of production per annum? The total cost is equal to production cost plus setup cost plus carrying cost. Many a times production cost is not given in the question. So what we do is we compute the production cost. What is the formula for computation? Annual production into cost of production per unit.
Cost of production per unit is calculated by taking your simple cost sheet funda, which is material plus labor plus overheads.
Setup cost is equal to number of setups into setup cost per run. Now what is the number of setup? That is annual production divided by quantity per batch.
Number of setups are also called as number of batches or number of production runs. You can also compute setup cost per run if it is not given in the question. That is basically equal to cost to set up the machine. And if say the question is giving you the setup time for the machine, then based on such time you can add labor and overhead costs. Remember, in this we don't add material costs, just the labor and overhead costs for the setup time required for the machine for each setup.
Carrying cost per annum is equal to quantity per batch divided by 2 into carrying cost per unit per annum. Many a times what happens is the question does not specify, or the question specifies the carrying cost per month. So in that case we compute carrying cost per annum by multiplying it by 12.
Or you may also calculate carrying cost per unit per annum is equal to carrying cost percentage per annum multiplied by cost of production per unit. This concept is rare, however this is also possible.
Fourth, how to compute economic batch quantity? It is as similar as that of EOQ. The formula here is root under 2 into annual production into setup cost per run divided by carrying cost per unit per annum.
What is EBQ? EBQ is the quantity per batch that if produced, the total relevant batch cost will be minimized. Total relevant batch cost comprises of 3 items: production cost, setup cost and carrying cost. Usually production costs are not considered relevant items for EBQ computation. It is just the same concept that we have learned in EOQ concept. This total relevant batch cost can also be computed using similar formula like we have learned in EOQ. This formula here is root over 2 ASC, where A is annual production, S is setup cost per run and C is carrying cost per annum. This will give us the total of setup cost and carrying cost.
Time interval between 2 runs is computed by dividing 365 days or 12 months or 52 weeks divided by number of runs.
This completes batch costing.
Operating costing. Cost per unit of service is equal to total cost incurred divided by number of service units rendered. What is this service units? This is the composite cost unit which we have studied in the operating costing chapter, such as passenger kilometer, room days or patient days. How to compute the total cost? That includes fixed cost plus variable cost plus the maintenance cost.
The first industry for which you should study is hospital industry. In hospital industry, the cost unit is patient days. Patient days are computed as number of patients capacity or number of beds into occupancy percentage into days for which hospital is being run. Then we may be required to find total cost or profit using those patient days or bed days. Question may also require to find about cost per patient day, and that will be total cost divided by total patient days. Sometimes question may also ask you to find break-even number of patient days. For that, you will prepare statement in marginal costing format, and that would be total revenue minus total variable cost equal to contribution less total fixed cost is equal to profit. Post that, you will take contribution per patient day, which will be nothing but average contribution per patient day. That means total contribution divided by total patient days occupied. This will give us average contribution per patient day, and break even would be total fixed cost divided by average contribution per patient day. The result will come in terms of patient days.
Hotel industry. In hotel industry, the composite cost unit is room days. How to calculate room days occupied? Number of rooms operating into occupancy percentage into days per period. Now, how to calculate the cost per room day? Total cost divided by total room days.
Many times in hotel industry questions, you would be asked to find profits also. So the working would be in the same way. The rent per room day would be given to you. So you will find total revenue and subtract total cost to get the profit. While working on hotel industries, the question may also ask you to find rent per room per day. So those questions are solved using equivalent number of room days. If you remember, say there are two types of rooms, single room and double room. You will find room occupancy days for each, and equivalent relationship between these two rooms would be given. Say 1.5 times rent is charged for double room as compared with single room. So you can take single room as 1 and double room as 1.5. So accordingly, total equivalent number of single room days will come, and this will be used to find out rent per single room day first, and then using that you will be finding rent for double room. So you also need to remember here that some cost may be given based on room days. Example, lighting, power. These costs may be based on room days. That means the rate per room per day would be given to you in the question. You will multiply it with room days occupied to find out the total cost.
Taxi service. Here the cost unit is effective kilometers. How to calculate effective kilometers? Total kilometers minus empty journey. What are the steps? The first step, we need to find the operating cost. Here we will take the fuel for all kilometers. Step 2, we will find effective kilometers. That means the kilometers where there were passengers. Step 3, now we will divide the step 1 with step 2. That is operating cost divided by effective kilometer to find cost per effective kilometer.
In taxi service, we just have single cost unit, that is kilometers. It's not composite. Transport sector. We have here two types of transport. One is passenger transport and another is goods transport. Passenger transport, the cost unit used here is passenger kilometers. It should be computed into two steps. Step number 1, find out total kilometers traveled. And step number 2, find out passenger kilometers. To find out total distance traveled, we should take number of trips per day multiplied by distance traveled per trip, multiplied by days per month, multiplied by months per year, multiplied by number of vehicles operating. Number of vehicle operating means number of vehicles that the transport company has multiplied by vehicles in perfect working condition percentage. Once you have got this, you use this for calculating the fuel cost and other variable costs associated with distance run. Then you calculate passenger kilometer by multiplying the above kilometers with seating capacity and occupancy percentage. Once you get the passenger kilometer, you can use that to find out cost per passenger kilometer, which in turn can be used to find out fare per passenger kilometer. Cost per passenger kilometer is equal to total cost by total passenger kilometers. Fare is also called as takings in case of passenger transport. In case of passenger transport, both sides of a round trip are always carried with passengers. So whenever number of trips are given, we try to assume those trips are round trips. One round trip is equal to 2 trips. Whenever the question provides you number of trips as 5, you may assume that those are 5 round trips and solve the question by taking 10 trips in total. Next is goods transport. In case of goods transport, the cost unit is ton kilometers. There are two types of ton kilometers. One is commercial ton kilometer, another is absolute ton kilometer. Commercial ton kilometer is determined by averaging the weight carried. So we have average load carried in all the various trips. It's the simple average of all the weights multiplied by total distance traveled with weight. We write with weight because if there is any distance traveled without weight, then you should exclude that. Absolute ton kilometer means you will not be averaging anything. You would be taking exact weight carried multiplied with the exact distance traveled with such weight. And if there are multiple trips, then we add up all such weight into distance and take the total. Freight is equal to cost plus profit. Freight is equal to cost plus profit. Here the selling price is called as freight. In case of goods transport, both sides of round trips are seldom occupied. Usually only one side of round trip are occupied with weights. So which side will be occupied? The question may specify that. So while calculating the fuel cost, you should consider both sides of the round trip because fuel will be used in both sides of the trip. But while calculating ton kilometers, you should take only that side of the trip where the weight has been carried. So you have to be careful while working out its calculation.
Next we will compute for airlines. What is the cost unit here? Either number of flights, trips or number of passengers traveling.
Per flight, you have to take everything on one flight basis.
Sixth, cinema. Here the cost unit or the composite cost unit is man shows or sheet shows per annum. The formula for which is number of men or seat into occupancy percentage into shows per day into days per year.
Contract costing. Normally in case of this method, which is used by mostly construction companies, the challenge is to calculate their profits, not the cost. Why there is a challenge? Because most of the work undertaken by them doesn't get complete within 1 year. So if work is not completed within a year, how can they recognize their revenue? So the entire science here has been curated to derive how they can recognize their profits. There can be two situations. One, work is completed within 1 year. In that case, nothing to be done. It's just contract price is known and that can be fully recognized as revenue as work is completed. Less whatever cost has been incurred on the contract will give you the profits. But if the work is not completed, then we have to follow certain steps.
Step 1. Find the notional profit. What is notional profit? Notional profit is equal to work certified minus cost of work certified. How to compute cost of work certified? Total cost up to date less cost of work uncertified. Cost of work uncertified is equal to cost up to date multiplied by work uncertified percentage divided by work completed percentage.
Step 2 is to find out degree of completion of work, and then based on that we derive the profit to be transferred to PL. To find out degree of completion of work, we take architect's certificate. So whatever architect says, that is only considered as work completed. So if work completed percentage is given to you as certified by the architect, then just take that. Or if work certified is given in the form of amount, then divide it by contract price to find out degree of completion in the form of percentage. Next you have to see the slab of these percentage of DOC to determine how much profit would be transferred to PL. So if degree of completion is within 24.99%, then no profit would be transferred to PL. If degree of completion is from 25 to 49.99%, then you will transfer 1/3 of notional profit to PL subject to cash realization. That means you will multiply that further with cash received by work certified. What is cash received by work certified? It is the proportion of cash received on work certified by the architect. The difference is called as retention. If work certified is 5 lakh and cash received is 4 lakh, that means 1 lakh is retention which has been kept by the contractee for security purpose such that contractor completes the work on time. If degree of completion is from 50 to 89.99%, then 2/3 of such notional profits multiplied by cash received by work certified is transferred to costing PL. And if degree of completion is 90% and above, then we usually follow estimated profit concept. Step 3 is to find out how much profit would be then left after transferring profits to PL. So one part of notional profit is transferred to PL using step 2, and then the remaining part is transferred to profit reserve. So profit reserve is equal to notional profit minus profit transferred to PL. What if there is notional loss? If there is notional loss, then you don't apply any DOC concept to find out how much loss to be transferred to PL. In that case, you transfer the entire notional loss to PL and there will be no profit reserve as such in that case.
How to account for profit when the degree of completion is more than 90%? There are 5 methods under this. The first method is estimated profit into degree of completion percentage into cash received on work certified. This is the most preferred method. Or estimated profit into cash received upon contract price. Method 2, estimated profit into degree of completion percentage. This formula is followed when cash received till date is not known. Method 3, estimated profit into cost up to date divided by estimated total cost. Method 4, estimated profit into cost up to date divided by estimated total cost into cash received upon work certified. Method 5, notional profit into cash received upon work certified.
In many questions, we have used this concept even if DOC was less than 90%. The prime criteria for using this estimated profit concept is you should know estimated profit. To calculate estimated profit, we use contract price minus cost up to date minus estimated further expenses to complete the contract. So in case in your questions you have estimated further expenses known to you and still DOC is less than 90%, you may use this concept. All the 5 methods would give different answers. If the question asks you further which one to be selected from these 5 methods, then the method which is giving us the least profit is the best. You have to remember all the 5 methods in order to proceed for the exam, and also you should know for theory questions and answers as well. Next is escalation clause. This is basically a benefit given to the contractor in case of a fixed price contracts. A contract once entered can be of 2 types, fixed price contract or cost plus contract. Cost plus contracts are not our scope of study. However, in that case, whatever actual costs are incurred, a percentage is charged on such actual cost and such profit is realized by the contractor each year. It doesn't require much of calculation, so we don't prepare it for practical purposes. However, you should know it for theory purposes. It is very popular in case of big government contracts. But in case of small contracts, we want to fix the price of the contract at the date of signing of the contract. Usually these contracts gets completed over a longer period of time. At that time, it may happen that contractor's cost has increased. So contractor may face additional losses. So to protect the contractor against such increase in price, we give them an advantage known as escalation clause in the contract. This escalation clause gives the opportunity to the contractor to charge extra amount to the contractee in case of price rise of material or wage rate rise of workers. To determine this, there's basic formula which is quite close to material price variance or labor rate variance, but it's just close, it's not the same. The formula here is actual price minus standard price into standard quantity. But what is the formula in case of material price variance?
In case of material price variance, the formula is standard price minus actual price into standard quantity.
Into actual quantity. So we have to be very careful what formula is for material price variance and what formula is for escalation clause. Escalation clause is the clause for additional price, not for additional quantity. If additional quantity has been used, then escalation clause is not enforceable. If additional price has been incurred, then escalation clause is enforceable. Sometimes contractor or contractee may impose a different kind of escalation clause which does not allow the contractor to charge the full increase to the contractee. Then the calculation may be somehow like this. You'll take actual cost that has been incurred by the contractor against material or wages, subtract standard cost, assuming that there is no increase in quantity, the difference is only because of increase in price. The result of this two would be gross escalation. Then you'll subtract standard deduction say 5% or 10% of such gross escalation against which no compensation will be paid by the contractee. The remaining amount is called as allowable escalation, and a percentage of allowable escalation only would be paid by the contractee. This escalation amount is usually supposed to be part of the new work certified. If the work certified is not incorporating this escalation amount, then we have to include that in our contract account just below the work certified. This escalation amount is not used in working out profit to be transferred to PL, where we also need work certified.
Let's discuss the format of contract account. First, we will debit all the expenses. If any material is left on the site, it will be on the credit side. By reducing the cost of materials at site, we get the cost till date. Cost till date is transferred to the debit side. Now, we will charge the work in progress, work certified, which will be the work certified by the architect or surveyor, and the work uncertified will be taken in cost. The difference will result in notional profit. Out of this notional profit, we will transfer the amount to PL account, and the amount left is transferred to PL reserve.
Okay, so the amount that is transferred to PL is called as profit from contract. That profit is not the profit of the contractor's company. That is just a profit from contract. To find out the net profit of the contractor's company, we prepare PL account. Please note, this is the contract account. This is not PL account. At the end of the year, every company prepares its own PL. So this PL account will be prepared by having the first item on its credit side as by contract number ... account. This contract number ... account will be basically showing this profit which is being sent to the PL from contract account. On the debit side, we will have those items of expenses of the company which could not be charged to the contract account. There can be some advertisement expenses, or there can be some unabsorbed depreciation for the time for which the plant was not at the site. The result would be the net profit of the contractor. While doing work in the contract, many times there are abnormal losses. Those abnormal losses are not charged to the contract. If there is any kind of abnormal loss of material, we deduct it from the material cost and charge it to the main PL of the contractor. If there is any kind of insurance claim realization from those abnormal losses, then you deduct that insurance claim from the abnormal loss to find out the net abnormal loss, and that also is debited on net basis to your company's PL. Remember, even if you are following estimated profit concept, the contract account flow does not change. It still remains the same. Estimated profit concept only changes the way you are calculating the profit to be transferred to PL, not the contract account.
If any escalation persists, it will be added to the work in progress. Now, sometimes what happens in the question is that the contract account is prepared for multiple years. In that case, the flow will be same. But in the second year, this work in progress will be transferred to the debit side or will be carried forward as the first item. And this PL reserve will be transferred to the credit side as the second item.
Many times, date of contract is very important to find out the expenses that you're debiting to the contract. You may be required to prepare contract account on 31st March and contract is being undertaken on 1st July instead of 1st April, and some expenses are given to you on monthly basis. So don't just multiply them by 12 because contract is being done only for 9 months on the site in the year. So it's very important that you check the date of the start of the contract before starting the question, and this will also help you to determine whether the question is being asked for first year or second year of the contract.
Now if we are asked to prepare the balance sheet, then how will we prepare? We will prepare only the extract. The work in progress will be shown under the assets, where we will record the work certified, cost of work uncertified, escalation amount if any, and we will less the cash received from contractee. In the liability side, we will record the PL reserve. Sometimes we also reduce the PL reserve from the work in progress and record the net amount only.
Full balance sheet can only be made when full opening trial balance is given to you in the question and if it is specifically asked in the question. Many times the question will also ask you to prepare contractee account. In case of contractee account, we start with writing the cash received. The entry for that would be bank to contractee. So in contractee, what you will write? By bank. The balancing figure will be called as to balance CD. And this balance CD will be carried over to the next year as balance BD. And again, next year, whatever cash will be received, that will be recorded as by bank. And this way, the balance will be just carried forward. The entire account will only be settled when the contract is completed. When the contract is completed, we don't have any WIP in the balance sheet. And also in the contract account, we don't write any further by WIP in the last year. In the last year, the work is complete. You will only have one step in your contract account, and that would be two expenses on the debit side with all carry forward from previous years. Means you will carry forward your previous year WIP on the debit side and previous year's reserve on the credit side. Then you will write by contractee account with the full contract price on the credit side. The net result would be your net profit or loss, which will be going straight to PL. No reserves will be made. So all WIP will get vanished in the last year of the contract, and in the balance sheet also all WIP will get vanished, and profits will go to the PL, respective PL, the main PL of the company. Even this profit reserve will get vanished in the last year. All will get adjusted ultimately. The new picture which will come forward, if contractee account is unsettled, then it will come as a debtors in the balance sheet. That's it.
Joint product and byproduct. Treatment of byproduct. Byproduct is treated like normal loss or treated like main product. So what will be its treatment if it is treated like normal loss and sold at the separation point?
We will identify its net sale value at separation point and credit it to the process account where it is originating.
What will be its treatment if it is sold after further processing?
We'll identify its net realizable value, and it is done by deducting three items from its sale value after further processing. And those three items are estimated profit on further processing, estimated selling expenses, and further processing cost.
What will be its treatment if it is treated like the main product?
In that case, we apportion the joint cost of the process to this byproduct as well.
How to compute joint cost? The format will be material plus labor plus overhead minus normal loss realization minus byproduct realization. And now the resultant amount will be split into the main products.
How to split this net joint cost among main products? There are several methods. Let's learn one by one. The first method is physical measurement method. It says you have to apportion the joint cost among the main products in the ratio of physical quantity produced of that product.
The formula is total joint cost into units of a product divided by total units of all the products. The second method is market value at separation point method. What is its formula?
Here first you find the market value at separation. Note its market value. That means you have to take total value, which is equal to quantity produced multiplied by selling price per unit at separation point. Use this market value ratio to apportion the joint cost.
Sometimes goods sold are given in the question. Then how to find quantity produced? The formula will be goods sold plus closing stock. Now moving on to the third, market value after further processing method. What is its formula?
Here market value is equal to quantity produced after further processing multiplied by selling price per unit after further processing. So you will get the market value after further processing. It's also called as final sales value. Use its ratio to apportion the joint cost.
NRV method or notional sales value at separation point method. How to compute the NRV of the main product?
NRV of main product is computed using sales value after further processing minus two items: estimated selling expense and further processing cost. This is called as notional sales value because we use this method when we don't have the sales value at separation point. So definitely to make the product sellable, we are further processing it and selling it. We are doing back calculation to derive its sale value at separation point. To say ourselves that we are at sales value at separation point, we are only deducting the further cost from the final sales value.
How to compute the NRV of byproduct?
NRV of byproduct has one extra item in its deduction, which is estimated profit on further process. We deduct this only in case of byproduct NRV, but in case of main product NRV, we are not deducting estimated profit. Byproduct NRV is used only to compute the treatment of byproducts. It's not to be used for apportionment of joint costs. It's just a comparison given here to help you understand the difference.
Fifth, average unit cost method. What is its formula?
Its formula is total joint cost divided by total quantity produced. The result of this method is same as the first method, which is physical unit measurement method.
Next, survey method.
Survey method means we are not doing anything. The surveyor is coming and giving us an estimate of apportionment of joint cost.
Reverse cost NRV method.
This is extremely important. Here, if you compare this with the NRV method, one difference is there, which is the profit part. So whenever in question we have profit margin for specific main product given to us, then we always use reverse cost NRV method, which is the NRV only with an additional item of deduction, which is the estimated profit margin. Now this estimated profit margin is the profit margin from the entire product, from joint process till further process. It's not that it's the profit margin for further process or just the main process. It's the entire margin which we deduct to find out the net NRV. Since profit has been deducted, we also call it as reverse cost NRV. Sometimes in question they refer this as just NRV method. They are not saying that it is reverse cost NRV. So make sure that we are using the right term for your understanding. If profit margin is given, we will call the NRV only as reverse cost NRV.
Constant gross profit margin method.
Here there are two basic steps. Step number one, you find out overall gross profit percentage. How it is computed? We have to find out total sales of all the main products after further processing and subtract total joint cost, subtract total selling expense, subtract total further processing cost to get total GP. We don't need product wise details here. So total GP will be divided by total sales to find out overall GP percentage. Step 2 is to find out reverse cost NRV using this overall GP percentage. So this will give us the final result as share of joint cost directly. You know what is interesting here? In our previous reverse cost NRV method or NRV method or market value method, we were using those as ratio to apportion the joint cost. But here in this method, you don't need ratio. The ultimate result after deducting 3 items from your sales value is the joint cost breakup only.
The next method, the contribution margin method.
Here the basic funda is variable cost will be apportioned in the ratio of actual output produced and fixed cost would be apportioned in the ratio of contribution earned by the products. So that means in order to use this method, we must have split off our joint cost into variable cost and
Fixed cost.
So what will be the steps?
The steps will be: first, apportion the variable joint cost. Second step, find contribution. Third, apportion the fixed cost. Step 4, now you have to find the share of joint cost,
Which will be total of
variable cost plus fixed cost.
right.
Now, how to select the best method? If profit margin is given, then use the reverse cost NRV as the method, and if not given, then find the market value at separation point or use the notional net realizable value.
If question is specified the method, then use those methods only. There is another very important calculations required for joint product and byproduct understanding, which is further processing decision. So to decide whether a joint product or byproduct should be further processed or not, we have 2 ways. First is to compare the statement of profit with further processing and the profit statement without further processing. The second method is to find out incremental profit. So there we find first incremental sales less further processing cost. If incremental profit is positive, we advise for further process.
So here we complete the byproduct and joint product. Process costing. Valuation of output in each process. What are the steps? Step 1. Debit the process account with all the expenses. Step 2. Credit the process account with estimated normal loss realization. Step 3. Find the estimated rate per unit of output.
Estimated rate per unit is equal to net cost on the debit side minus estimated normal loss realization divided by total inputs on the debit side minus estimated normal loss units.
Step 4. Find the value of abnormal loss or abnormal gain. Step 5. Adjust the value of normal loss account with cash or abnormal gain. Step 6. Transfer the net balance of abnormal loss or abnormal gain to the profit and loss account.
Inter-process profits. We are just discussing its key points which will help you to solve the sums. What is inter-process profit? Profit earned when output is transferred from one process to another at above cost price is called as inter-process profit. The price charged by one process to another process is called as transfer price. Normally, when a process is selling to external customer, the price is called as selling price. But when it is charging to another process, the price is called as transfer price. The process managers are allowed to identify the market value of their output, which forms the basis of determination of their selling price or transfer price. So when there are multiple processes and the process managers are made in charge of those processes in such a way that they can run their process independently, so they will always want any transfer from their process to be done at some profits. So what can be the price for a semi-processed product? In that case, they will go to the market and identify what is the possible fair price of such intermediate product, and that price will form as basis of their selling price or transfer price.
If there is a stock in the process, there will be calculation of stock reserve or profit margin of the previous process. The stock is valued at weighted average basis, and in the balance sheet of the company, the stock is valued at cost, means any profit reserve is removed.
While doing this working, sometimes question will also specify that the stocks of the process would be valued at prime cost. So that means you will be debiting in your process material and labor, and after that you will be showing one total prime cost, and from that prime cost will be deducting your closing WIP of the process. Then you will proceed to add overhead items. In this inter-process profit situation, the format of process account is different. We write particulars cost profit total and then again particulars cost profit total. The flow of calculation is material, labor, prime cost, less stock, usually adjusted at prime cost, then net prime cost, or you don't need to name this, then add overheads, then total cost. On this total cost, you will be adding profits to find out the transfer price to the next process. The transfer price is nothing but the sale value, so that will be created on the process account, and this sale value will become in turn the cost of the next process. And this flow continues. It's very recommended that you see the proper sums that has been done with you as against this topic.
WIP valuation. When closing WIP is given along with the degree of completion.
In this kind of scenario, what we learned in the first situation when there was no WIP, the step 1 and 2 remains the same. That is, you will always open a process account, debit the process account with all the expenses, credit the process account with the normal loss at its realizable value. The third step, which was to find out estimated rate per unit, which we used to do in a small working note there, now that is being changed into 3 steps.
The first step, we need to find the equivalent units. How do we complete equivalent units? Finished goods plus closing work in progress into degree of completion plus abnormal loss into degree of completion less abnormal gain into degree of completion. You must keep in mind that for abnormal gain, the degree of completion is always 100%.
One more, either you will have abnormal loss or you will have abnormal gain. You will not have both at the same times. We have written here both together, but you will have either abnormal loss or abnormal gain.
The cost per equivalent unit is equal to total cost of component divided by equivalent units of that component. After that, value of closing stock of work in progress, abnormal loss, abnormal gain or finished goods is equal to summation of equivalent units of element into cost per unit of that element.
When opening WIP is also given, then we can have three situations. One is FIFO, another is weighted average, or third is material added is also given. FIFO to be used only when DOC of opening WIP is given. Weighted average is used when breakup of opening WIP cost is given. And material added is used when you have four items of elements which are main material, added material, labor and overhead given to you in the question. Main material are the materials with quantity and amount. Added material are the additional material with no quantity, just the amount.
Under FIFO method, the first step is to find the units completed. That will be opening work in progress multiplied by remaining degree of completion. For new, it will always be 100%. Step 2, rate per equivalent unit is equal to current cost divided by equivalent units. You must ignore the opening work in progress cost. Step 3, finished goods is equal to opening work in progress cost plus equivalent units into rate. Abnormal loss, abnormal gain is equal to equivalent units into rate. Closing work in progress is also equal to equivalent units into rate.
If you see in this FIFO method, opening WIP cost is not considered in the second step, but it is considered directly in the third step. And in the first step, opening WIP units are considered but with remaining DOC. That means not the part that has already been completed.
Average method. Units completed will always be taken at 100%. Second, rate per equivalent unit is equal to opening work in progress cost plus new divided by equivalent units. 3. Finished goods is equal to equivalent units into rate. Abnormal loss or abnormal gain is equal to equivalent units into rate. Closing work in progress is also equal to equivalent units into rate.
If you compare FIFO with average, what you will see is in average we are adding opening WIP cost in the rate itself. So we need not add it again in the valuation statement into any of the items. So because of its inclusion in the rate, it is getting split into all the items. The rate comprises of opening WIP cost. That means every valuation items is considering the impact of opening WIP.
For material added under FIFO, the main material will always be taken at 100%. The added material, the degree of completion will be given in the question for labor and overhead as well. Normal loss realization to be deducted from the main material. Third, normal loss will be given as a percentage of throughput. That means opening work in progress plus new minus closing work in progress. And last, finished goods, abnormal loss, abnormal gain or closing work in progress. How we will calculate equivalent units into rate per unit.
One line is very important here, normal loss as a percentage of throughput. Question may many times remain silent about normal loss percentage applicability. If nothing is mentioned, in general we assume that percentage is applicable on total input, that is opening WIP plus new units. But many times in your institute solution you will find that they have taken on throughput, that is opening WIP plus new minus closing WIP. So be careful. So when you are reviewing your institute solution, make sure you do what institute wants you to do. In general, if nothing is mentioned, we assume normal loss is as a percentage of total input. If question is mentioning that it is as a percentage of throughput, then you should take on throughput.
Here we complete the process costing chapter.
Budget and budgetary control. There are three things to learn in this chapter. One is functional budget, another is flexible budget, and the third one is performance ratios. Let's understand functional budget. The sequence of preparing these budgets are First you prepare sales budget, then production budget. From production budget there are two budgets. One is material budget, another is labor budget. Let's start with sales budget.
Sales budget. Under this sales budget, we compute the sales unit first. Sales unit is equal to estimated profit divided by profit per unit. After getting the amount of units of sales, we calculate the sales amount, that is equal to sales units into selling price per unit.
This sales unit can also be computed using concept of marginal costing, which is fixed cost plus desired profit divided by contribution per unit.
Second, in production budget, the main thing is production quantity. How do we compute production quantity? Is equal to sales unit plus closing stock of finished goods minus opening stock of finished goods. Now, to calculate the production cost, that is equal to production quantity multiplied by cost per unit.
The third is raw material budget. In this, there are two steps. One is to find out raw material consumption. The second is to find out raw material purchase. To find out raw material consumption, we take raw material required per unit multiplied by quantity to be produced. And then to find out raw material purchase, we take raw material required, that is raw material to be consumed, plus closing stock of raw material minus opening stock of raw material. Using this quantity of purchase, we also find raw material purchases in rupees, which is equal to raw material purchase quantity multiplied by purchase price per unit.
Labor budget. In this, we compute the labor hour requirement. Labor hour requirement is equal to labor hour required per unit multiplied by the quantity to be produced. Now, the number of workers to be required, that is equal to labor hour requirement divided by hours per worker. Labor cost in rupees is equal to labor hour requirement into wage rate per hour.
Next is flexible budgets. Flexible budgets are prepared using three steps. First step is to identify the behavior of cost. The given cost is either fixed or variable or semi-variable. If it is fixed, the total amount would be same. If it is variable, the per unit amount will be same. And if it is semi-variable, neither total nor per unit would be same. If it is a semi-variable cost, you have to take its breakup into fixed and variable. The calculation will be variable cost per unit is equal to change in total cost by change in units. Sometimes the breakup may be given in the question. And if you have to find fixed cost, it will be total cost minus total variable cost. Third step is to prepare the flexible budget required at various capacity levels. How this functional budget and flexible budgets are different? Functional budgets are budgets of different departments at a specified level of activity. But flexible budgets are the budget at different level of activities where we are not sure about one specific level of activity to occur in the coming period.
Performance or budgetary control ratio. The first one, activity or volume ratio. It is equal to actual output divided by budgeted output, or standard hours for actual output divided by budgeted hours. Here the keyword is bed pe soya to mila aram, which will be explained by sir.
So how bed pe soya to mila aram? It is only to be known when you sleep on your bed. But anyway, you see, this is bed, this is soya. So S and B is equal to aram is equal to A. So this is one keyword to remember. Second, capacity ratio, actual hours by budgeted hours. So the keyword to remember here is A or B के बीच में आया C. Can you understand now how?
Yes sir. A and this is B. So A, B. When we divide, we get C.
Yes, right. So what is the third one? Third one is efficiency ratio. What is it?
Standard hours for actual output divided by actual hours. Here the keyword is शाहरुख और ऐश्वर्या के बेटी का नाम एफी.
कैसे हुआ? How it is standard hour, actual hour, Shahrukh and Aishwarya, and daughter's name is Effie. Don't connect this Shahrukh with your Shahrukh Khan or Aishwarya with Aishwarya Rai. Any person's name can be Shahrukh, any women name can be Aishwarya. Okay?
Next, standard capacity usage ratio, that is budgeted hours by maximum hours.
Actual capacity usage ratio is actual hour by maximum hours. keyword here is capacity usage. So whenever word capacity usage is given, you take the base as maximum hours. So standard capacity usage means budgeted by maximum. Actual capacity usage means actual by maximum.
Actual usage of budgeted capacity ratio, that is actual hours upon budgeted hours.
This is same as the previous capacity ratio. A और B के बीच में आया C. If you see, A और B के बीच में आया C.
Next, calendar ratio, that is actual working days divided by budgeted working days.
Very nice. One more thing to remember here is, if you are asked to calculate just first three ratios, then you can apply a cross check, which is A is equal to C into E. इक्का फेंको तमाशा देखो. इक्का को playing cards में ace कहते हैं. So ace means activity is equal to capacity into efficiency. So sometimes you may be required to use this to find out any ratio if the two ratios are given. There is one more theory which is very popular in exam or in objective questions. It is zero-based budgeting. What is zero-based budget? It is a budget prepared after following these 5 steps. You start understanding the requirements. You evaluate why the requirements are actually our requirements. Then you justify what will be the benefit of having such requirements. If we do such activity, what can be the benefit to the organization? And if it is accepted, then streamline which activity should be done and which should not be done, and what should be done in priority, and then execute. So this method was introduced in US federal budget once, and then slowly it got adopted among all of the companies across the world. There is another form of budget which we call as rolling budget. Sometimes it is also asked in your objective questions, which says that every year you will be making a budget with small period. Period 1 may be 1 quarter, and as soon as 1 quarter lapses, the budget would be reviewed and renewed by including the next quarter in the budget, such that the budget still remains of the 1 year. So as soon as one period goes by, the budget will be rolled forward to include another period of the next year. So that those are called as rolling budgets. We don't read it practically, but some understanding of it would help you to solve objective questions.
ZBB is known as zero-based budget. Why? Because this budget is prepared from the scratch. Means we take no base, zero base. That is why the name is zero-based budgeting.
Very nice. In general, the budgets, the way it is prepared, is called as traditional budgeting. In traditional budgeting, the first budget is always the budget with zero base, but in subsequent budgets, there is a tendency to keep the previous budget as base. So that may invite lot of misappropriations and unwanted spending. So in zero-based budgeting, every budget is prepared as if there was no base ever. So this way we conclude our discussion of budget and budgetary control. Marginal costing. The first one to remember here is contribution is equal to sales minus variable cost or fixed cost plus profit.
Second, PV ratio, that is contribution upon sales into 100, or contribution per unit divided by sales per unit into 100, or change in profit upon change in sales into 100.
Third one, break-even point is equal to fixed cost by PV ratio. The answer will be in rupees since you have divided by PV ratio. But if you want your answer in units, you have to divide fixed cost by contribution per unit. Break-even sales are the sales where you earn no profit or no loss. Here, total contribution is equal to total fixed cost.
Sales is equal to fixed cost plus profit upon PV ratio. Similarly, we divide by PV ratio, we get the amount in rupees. But when we need in units, we divide it by contribution. That is fixed cost plus profit divided by contribution per unit.
Fifth one, cash break-even point. It is equal to cash fixed cost by contribution per unit or cash fixed cost by PV ratio. How do you find cash fixed cost? It is equal to total fixed cost minus non-cash expenses like depreciation.
Margin of safety. It is the amount of sales that we do over the break-even sales. The formula here is sales minus break-even sales, and if we want in rupees, the formula is profit upon PV ratio. If we want in units, the formula is profit divided by contribution per unit.
Next one. This two I will do together. These are my favorite Jugalbandi Jodis. Break-even sales ratio plus margin of safety ratio is always equal to 1. Why they are called Jugalbandi? Means if you want to find one, the other one will be just beside it. So break-even sales ratio, if you know, then you can easily find MOS ratio as a difference between 100 minus the break-even sales ratio. If break-even sales is 60, MOS ratio will be 40. If break-even sales is 30, MOS will be 70. Similarly, if you know MOS, you can find break-even sales. If you know break-even, you can find MOS sales. One more addition here I would like to do. Break-even sales ratio is also calculated as break-even sales divided by total sales. If you put the formula of break-even sales here, it will come as fixed cost by contribution. Similarly, MOS ratio is equal to MOS sales by sales. And if you put the formula of MOS here, it will give us profit by contribution. Now, why I'm discussing this? Because many times you need this relationship to solve your questions. There is another Jugalbandi Jodi, which is variable cost ratio plus PV ratio is equal to 1. That means if you know variable cost ratio, you can easily get your PV ratio, right? Variable cost ratio is equal to variable cost by sales, PV ratio is equal to contribution by sales. So if PV ratio is 40%, variable cost ratio is 60%. If variable cost ratio is 55%, PV ratio will be 45%.
Ninth, indifference point. We compute indifference point when we have two situations and we need to evaluate the two situations. The formula here is change in fixed cost divided by change in variable cost per unit. We get the answer in units.
How do you choose then using this indifference point? So you have to see your expected sales level. If it is going to be more than the indifference point, then the option with high fixed cost is more preferable. If the sales is expected to be less than indifference point, then the option with low fixed cost is preferable.
Now, shutdown point, where we need to take the decision that whether we want to continue the business or shut down the business. The formula here is avoidable fixed cost minus extra shutdown cost divided by contribution per unit. We get the answer in units. Why we are dividing it by contribution per unit? If we divide it by PV ratio, we will get the amount in rupees.
The same interpretation here follows like indifference point. If expected sales is more than shutdown point, then the preferred option is to continue the business. If expected sales is less than shutdown point, then expected situation would be to shut down.
Minimum price of offer, that will be incremental cost plus profit if any, or total cost with offer minus total cost without offer is equal to incremental cost.
12th, economic cost. It is equal to actual cost plus contribution lost due to offer, and net economic cost is equal to economic cost minus contribution received from the offer.
BP of a merged company, it's equal to total fixed cost divided by the combined PVR of the merged company but at 100% capacity level.
When you're finding combined PVR of the merged company at 100%, you have to convert your sales at 100% and variable cost at 100% capacity to get the total contribution of the merged company at 100%. Then total contribution at 100% will be divided by total sales at 100% to get the combined PV ratio of the merged company. Next is break even with step fixed cost. Step number 1. First, try with initial range. So when you have step fixed cost scenario, you will have fixed cost varying according to range. Say it's saying like up to 100 units fixed cost is 1 lakh. More than 100 units fixed cost is 1,50,000. So if you have to find break even, you will first use the initial range, which is up to 100 units, and take its fixed cost and find the break even using this fixed cost. Say 1 lakh divided by contribution per unit. Assume that the answer is coming as 80, so it is lying within the first range, so you got the answer. But if the answer is exceeding the range of the first level, say it is coming as 110, then you can't use the same fixed cost which was applicable for 100 units. So you'll have to revise the break-even calculation by taking the new fixed cost of the second range, which is say 1,50,000, and then use that to find your break-even point.
Fixed manufacturing overhead absorption rate is equal to budgeted fixed overhead divided by budgeted basis. Fixed manufacturing overhead absorbed is equal to fixed manufacturing overhead absorption rate into actual basis for the period.
Under our over absorption for fixed manufacturing overhead, it is equal to fixed manufacturing overhead absorbed minus actual manufacturing overhead incurred. If the difference is positive, it is over absorption. If the difference is negative, it is under absorption. Many times students ask me, sir, why you are doing this in marginal costing only for manufacturing overhead and not for admin and selling overhead? While in absorption costing chapter, we learned that we can do this under over absorption for any of overhead items. Even in your control accounts, you were doing under or over absorption for any of the overhead items. But in marginal costing sums, we are only doing for manufacturing overhead. It's just to simplify the calculations. So in marginal costing, we just say that you take only manufacturing overhead as over or under absorbed if required, if asked in question, and other two, admin selling, let it be at actual and don't consider over or under absorption. In marginal costing, ideally all costs are shown on actual basis, not on absorption basis. But sometimes question asks you to compare this marginal costing with absorption costing. Only in that case we take fixed overhead on absorption basis for the purpose of showing the profit as per absorption costing, so that we can compare that with marginal costing.
The profit reconciliation statement. Here we reconcile the profit as per absorption costing with the profit as per the marginal costing. First, we take profit as per absorption costing plus opening stock overvalued less closing stock overvalued. We get the profit as per marginal costing. Here you can remember a keyword, that is Om Shanti Om, which signifies opening stock overvalued.
Very nice. Next is our key factor analysis. Key factors are also called as principal budgeting factor. Remember, in functional budgets we talked that the first budget is sales budget, but if sales is not a constraint and there is a key factor in the system, then even the sales budget will be prepared using this key factor system only. Although such kind of sums we are not doing, but the concept says that key factor is the first thing that is to be considered even you are preparing the sales budget. Key factor, what is it? It is that factor of production whose requirement is more than availability. It may be labor hours, machine hours, material quantity. Sometimes it can be labor cost in rupees or material cost in rupees also. What is the best use of available quantity of key factor? In order to do this, make sure that in every sums you are first identifying truly what is the key factor. Don't get misguided with just labor hour as a permanent key factor. So if say multiple resources are given in your question, you may do some working by checking how many hours are required in labor, how many hours are required in machines, and compare it with available hours to find out the real key factor. Usually in our current level of studies, we have only one key factor. So say there is one identified key factor which is labor hours, then how will you proceed with the calculation? Step number one would be to find out your contribution per unit of key factor. How it is computed? Contribution per unit divided by key factor required per unit. Step number two would be to prepare the ranking table. That is, you identify which product gives you the highest contribution per unit of key factor. This is also called as statement of profitability. So if question is asking you statement of profitability, you have to show the ranks only. And step number three is to prepare the optimum mix table. In optimum mix table, you start with allocation of your limited key factor to first rank to produce its maximum quantity which can be sold, and then move to second rank and third rank and fourth rank and so on. Maybe the last one would get the balancing figure of your available resource. There is one very important condition before you do this allocation for optimum mix, and that is pran jai par vachan na jai. What does it say? It says that sometimes companies may have committed to sell a specific product to a specific customer. Then at first the resources should be allocated for those commitments, and then remaining resource should be allocated as per the rank. Here we conclude marginal costing. Welcome to standard costing. Here we are going to study just two simple variances. One is material variance, another is labor variance. In material we have 5 variances. The first one is material cost variance. How to compute that? What is the formula?
Standard quantity into standard rate minus actual quantity into actual rate.
Then material cost variance has got two parts. One is material price variance, another is material usage variance. So let's understand how to calculate material price variance.
For material price variance, the purchasing manager is responsible. So we get the formula standard price minus actual price into actual quantity.
Do you remember escalation clause?
Yes, sir.
What is the formula there?
Standard price, actual price minus standard price into standard quantity.
Yes, there it was AP minus SP into standard quantity. Don't confuse this with escalation clause of contract costing. Second one is material usage variance or material quantity variance. What is the formula for this?
For this, the production manager is responsible. Here the formula is standard quantity into minus actual quantity into standard price.
Alright, and there is a cross check. What is the cross check? MCV is always equal to MPV plus MUV. And do you know, Rahil, one very interesting thing that happened in one of our mock tests, Sangram student, that the student did the entire calculation correct for MPV, MUV and MCV. He did not mention anything about adverse or favorable. So he got 0. So it is very important that the answer that you're getting, if it is negative, you should write
adverse,
and if it is positive, you should write
favorable.
The next two variances are coming from material usage variance, and those are computed only when company is using multiple types of materials to produce its product. And what are those two? Material mix and material yield. Material yield is also called as material sub-usage variance. So let's understand material mix variance.
Revised standard quantity minus actual quantity into standard price. Now how to compute the revised standard quantity? Its formula is standard quantity divided by total standard quantity into total actual quantity.
Next is material yield or sub-usage variance.
Standard quantity minus revised standard quantity into standard price, or total standard quantity minus total actual quantity into standard weighted average price.
How to calculate standard weighted average price? It is equal to total standard cost divided by total standard quantity. Alright. So do you remember the format of calculating material variance? We used to prepare material cost card, and in case of material cost card we have standard cost for actual output, and then we have actual output related actual cost. We then say QPA. So if you have just one material, then you just do this for once, but if you have multiple materials, you have to do it for all the materials together to find out the total amount. And against this, you will be making two additional columns, which are SP into AQ, and another column would be SP into revised standard quantity. These totals help you to compute these variances in an easy way. So when multiple materials are there, then to calculate material price variance, you have two options. Either you can do it for every material individually and add up, or secondly, you can just open the bracket. How will it appear, Rahil, when you open the bracket?
Standard price into actual quantity minus actual price into actual quantity.
And then you take the SP into AQ total from here and AP into AQ total from here. So what will happen? Instead of doing multiple times, you will be able to get your answer in just one line. The same thing you can apply for all. That is, for material usage variance, if you open the bracket, what it will be?
Standard quantity into standard price minus actual quantity into standard price.
So how will you take standard quantity into standard price? That will be coming from this total, and AQ into SP will be coming from this total. Similarly, for mix variance, you can open the bracket RSQ into SP minus AQ into SP. RSQ into SP is this one and AQ into SP is this one. So this will help you to save your time in solving the question. But always remember, you have to write adverse and favorable after every variance. You can cross check your material usage variance, which will be equal to material mix variance plus material yield variance. Let's come to the next one, labor variance.
The labor rate variance is equal to standard rate minus actual rate into actual hours.
Labor efficiency variance is basically copy of material usage variance. It is standard hour minus actual hour into standard rate. And labor cost variance is combination of rate and efficiency, and it will be equal to
Standard rate into standard hour minus actual rate into actual hours.
sometimes labor idle time variance is also applicable. It's only used when in actual hours additional idle time is given. Those idle hours are abnormal idle hours. How do you calculate this variance?
0 minus actual idle time into standard rate, and idle time variance is always adverse.
Whenever you are calculating idle time variance, remember in that case this efficiency variance will have net actual hour, or you can say actual productive hours, and the cross check will then be labor cost variance is equal to labor rate variance plus efficiency variance based on productive hours, and you will also add labor idle time variance. Alright, so this is also mentioned here separately. And if multiple grades of workers are working together to produce the output, just like multiple materials were resulting into material mix and yield, here material labor will result into labor mix or labor gang variance and labor yield variance or labor sub efficiency variance. These are coming from your efficiency variance only. So efficiency variance will have two sub variances, which is mix and yield. How to calculate labor mix variance?
The labor mix variance is equal to revised standard hour minus actual productive hour into standard rate.
And how do you get revised standard hour?
Total actual productive hours into standard proportion.
What is standard proportion? It is same. That is your standard hour divided by total standard hours. Alright. And labor yield variance, what is the formula?
Standard hour minus revised standard hour into standard rate, or total standard hour minus actual productive hour into standard weighted average rate.
Yes, here also this is total actual productive hour. The word total signifies total of all grades of workers. Sometimes in question you will see that instead of details of hours for each grade, they are just giving the number of employees in each grade. So you can't solve the sums with number of employees directly. You will have to find out man hours. How do you get man hours?
Number of employees into hour per employee.
Alright. So how will you frame the cost card in case of labor variances? So labor cost card is basically the working before you proceed for variance calculation. Standard cost for actual output, actual cost will come, hours rate amount will come. These hours are man hours. After this we will have column for standard rate into actual hour, and then we have standard rate into revised standard hour. But say idle time is given. If idle time is given, then how will you make the column? If idle time given, then this is same, but the columns will come as standard rate into actual idle time. That will be the first column which will help us to calculate idle time variance. Then standard rate into actual productive hours. This will help us to calculate your efficiency, mix and yield variance, and then standard rate into revised standard hours. These columns will be made and total values will be required by opening the bracket, just as the case we discussed in case of material variance. Remember, only formulas will not help you. without seeing the sums exactly or solving the sums multiple times, the perfection will never come. Cost accounting standards, the most overlooked chapter. Do you know how much marks this carries for your exam? Minimum 11 and sometimes 18. So can you risk it? No, you have to study this. The popular theory topics from this chapter are objectives of cost accounting standards, scope of cost accounting standards, advantages of cost accounting standards, functions of cost accounting standard board. So make sure you have studied these topics from your material. You know, there are 24 cost accounting standards as on date. We have created one very unique way to remember all the names, because you will get questions in your objective where you will be asked to identify the cost accounting standard number for specific items. So let's read out and understand the story so that you are able to remember the names of the cost accounting standard. So cost accounting standard 1 is classification of cost.
यहाँ पर आप ऐसा इमेजिन करिए कि बहुत सारे पहाड़ हैं, कुछ बर्फ से ढके हुए हैं, कुछ बर्फ से नहीं ढके हुए हैं, तो हम अलग अलग पहाड़ों को क्लासिफाई कर रहे हैं. तो द कीवर्ड हियर इज पहाड़.
Case 2 capacity determination.
अब इन्हीं पहाड़ों के बीच में से एक नदी बह रही है और ये नदी बहुत ही तेज रफ्तार के साथ बह रही है, जो कि अपने साथ इतनी कैपेसिटी लेके चल रही है कि किसी को भी ले जाए अपने साथ. तो यहां से आप वर्ड याद रखेंगे, कैपेसिटी.
Case 3 is production and operation overheads.
एक बहुत ही सुंदर नजारा है जहां पर एक लड़की जो है वो अपने लिए और अपने परिवार के लिए खाना बना रही है.
So how does this खाना बनाना goes with production and operation overheads?
खाना बनाना, that means we are producing the food, so production.
Case 4 cost of production for captive consumption.
What is captive consumption? Captive consumption means self consumption. तो वो लड़की खाना खुद के लिए बना रही है. So here the word is captive consumption.
Case 5 is cost of transportation.
अब उसने खाना बना लिया है, वो खाना टिफिन में डालकर लेकर जा रही है अपने हस्बैंड के लिए.
So how does this connect with transportation?
लेकर जाना, टिफिन, ट्रांसपोर्टेशन.
Very good. Case 6 is material cost, Case 7 is employee cost, Case 8 is cost of utilities.
अब हस्बैंड खाना खा रहा है, खाना खा के वो बहुत इंप्रेस हो गया. उसने पूछा कि भैया किस चीज से बनाया तुमने खाना? तो उसने बताया कि मैंने इन चीजों से बनाया. फिर उसने पूछा कि किसने बनाया इतना स्वादिष्ट खाना? तो एम्प्लॉय. अब फिर उसने पूछा कि खाना बनाने के लिए सब सामान थे, गैस था? तो उसने बताया हाँ गैस था. तो गैस इज यूटिलिटीज.
एंड ये भी तो बोला कि पैकिंग अच्छे से की हो, बहुत बढ़िया से सजा के लाई हो, इसलिए पैकिंग मटेरियल कॉस्ट. देन Case 10 इज डायरेक्ट एक्सपेंसेस.
अब पति ने कहा कि मेरे लिए इतना स्पेशल क्यों किया, स्पेशली मेरे लिए खाना बनाया, लेकर आया, क्यों इतना स्पेशल ट्रीटमेंट?
So how does this connect with direct expense?
डायरेक्ट एक्सपेंस आर आल्सो नोन एज स्पेशल एक्सपेंस. तो स्पेशली मेरे लिए क्या, दैट इज बाय स्पेशल एक्सपेंस.
So how does this 1 to 10 comes as a story? Let's reconnect this story. So there is a big landscape where say there are various types of mountains and houses, and you got to classify those. And in that there is a very big river flowing in very high speed so that it can take away any house along with it. So it has good capacity to take away anything. The third is to produce something, so production overheads. So producing is cooking is also producing. And for whom she is producing? She is producing for herself and her family, not for selling to outsiders. So that's how it is captive consumption. Once the food has been cooked, she thought that she will take some transport to take it to the office of her husband or the factory of her husband. So transportation from transport of tiffin. Then husband while eating asked, it's very tasty. So what ingredients you had put today? So ingredients means material, and who has cooked means employee. Employees does the work, and where all the utilities available means gas and all were available. And he also appreciates packing was also done very beautifully, so that is packing material. And why so special for him? He was ultimately very much flattered, and so he asked, why so special for me? So special means direct expense. So this will help you to remember and connect the names with the story. The second part is a different story altogether. So it starts from admin overheads.
यहाँ पर एक बच्चा, एक लड़का है जो कि आप ऐसा मानो 11 साल का है, 11 इयर्स का वो है. सो यू कैन कनेक्ट 11 विथ एडमिनिस्ट्रेशन. उसने एडमिन में फ्रॉड किया, एडमिन का काम उसको दिया गया, उसने फ्रॉड कर दिया. तो यहां से आप 11 और एडमिन दोनों को कनेक्ट कर सकते हो.
And he went to jail. And jail is, in jail, if there are two rods, the two rods are 11, one rod. The boy is holding those two rods and standing in sad face. So this is 11 is equal to admin fraud. Cash 12 is repairs and maintenance.
अब जेल गया है तो जेल में कुछ काम करना पड़ेगा. तो जेल में काम मिला है रिपेयर करने का, कि भैया जेल को रिपेयर करो. तो रिपेयरिंग का काम कर रहा है. दैट इज वाई रिपेयर्स एंड मेंटेनेंस कॉस्ट.
After jail, you have to do repair work in the jail. 13 is cost of service cost center.
उसने इतना अच्छा रिपेयरिंग किया कि लोग खुश होके उसको प्रमोट कर दिया गया कैंटीन में, कि अब तुम कैंटीन में काम करोगे, लोगों को खाना दोगे, सर्विस दोगे. तो हियर इट कम्स फ्रॉम सर्विस कॉस्ट सेंटर.
Cash 14 is pollution control cost.
अब कैंटीन जो है वहां पे कुछ भी अच्छे से मैनेज नहीं किया हुआ है, हर तरफ गंदी सब्जियां पड़ी हुई हैं, बहुत गंदगी है, पोल्यूशन है. सो पोल्यूशन कंट्रोल.
Cash 15 is selling and distribution overheads.
खाना बन रहा है, खाना हर जेलर के पास लेकर जाना पड़ रहा है, डिस्ट्रीब्यूट करना पड़ रहा है. सो इट इज सेलिंग एंड डिस्ट्रीब्यूशन ओवरहेड्स.
Cash 16 is depreciation and amortization.
अब जब खाना लेकर जा रहा है तो वो देख रहा है कि जेल की हालत बहुत खराब है, टूटी फूटी है, मींस जेल पूरी तरीके से डेप्रिशिएट हो चुकी है.
Cash 17 is interest and financing charges.
अब वो बार बार ये सब काम कर करके बोर हो गया, इंटरेस्ट ही नहीं आ रहा है जेल में, कि अब नहीं रहना है जेल में, बोर्डम हो रहा है.
Cash 18 is research and development cost.
अब जेल से भागना है, रिसर्च एंड डेवलपमेंट करते हैं कि यहाँ से कैसे भाग सकते हैं.
Cash 19 is joint cost.
अकेले तो भागेंगे नहीं, और लोग चाहिए, आदमी ढूंढते हैं भागने के लिए, जॉइंट आदमी लाओ.
Cash 20 is cash on royalty and technical know-how fee.
जेल से भागना इतना आसान तो नहीं है, किसी जेल के अंदर के आदमी की हेल्प लेनी पड़ेगी, किसी जेलर को कुछ देना पड़ेगा, रॉयल्टी देंगे उसे भागने के लिए.
Cash 21 is quality control cost.
अब जेल से भाग गए, अब 21 पे क्वालिटी वाली लाइफ जिएंगे, एकदम अच्छी जिंदगी.
So when we were 11-year-old, we were jailed, and it took us 10 years to come out of the jail and live a quality life. That was age 21. 22 is cash on manufacturing cost.
अब अपना लाइफ खुद जीना है, मैन्युफैक्चरिंग बिजनेस शुरू किया है, अच्छे से मैन्युफैक्चरिंग करके बड़े आदमी बनेंगे.
Cash 23 is overburden removal cost.
अब इतना आसान तो है नहीं बड़े आदमी बनना, मैन्युफैक्चरिंग बिजनेस तो शुरू कर लिया है, पता चल रहा है हर रोज कोई ना कोई छुट्टी मार दे रहा है, काम का इतना लोड हो गया, बर्डन हो गया, एकदम ओवर बर्डन हो चुके हैं काम से.
By the way, overburden means the cost that is incurred when mining is done. So above the mine, whatever earth we have, those earth is called as overburden. Cash 24.
ट्रीटमेंट ऑफ रेवेन्यू. अब ओवरबर्डन से परेशान होकर मैं जा रहा हूं अपना ट्रीटमेंट कराने, तो ट्रीटमेंट करवा रहे हैं, तो ट्रीटमेंट ऑफ रेवेन्यू.
So the story doesn't ends here, but cash 24 के बाद कोई और cost accounting standard आया नहीं है. So we have to end our story here. So if you rewind this and listen it again, write down the story, imagine this story, so you'll always remember the entire cost accounting standards in sequence, and it will help you to score marks in exam. So this brings us to the end of cost accounting standard. So friends, how did you like this entire video series? Let us know in the comment box. We would be happy to read. And please, please, please spread the love. The more you spread, the more encouragement we will get to bring such things in future for you, for other subjects as well. Last but not the least, in spite of all these efforts, nothing will work if you have not practiced well. Practice is the key to your success. You must have practiced institute material, all questions, your past papers of exams, all questions, your model test paper, all questions. Your mock test should also have happened for entire 3 hours sitting, so that you are able to control your fear. If you need any help further, do not hesitate to get in touch with us. We would be happy to see you passing with bright colors. See you soon in Group 2 classes or in final classes. Thank you so much.